Test 1, 2, 3. The time?
Yep. You can start.
Recording in progress.
I call this meeting to order. I'm always want to say that. Thanks everybody for being here. Welcome to the Growth, Equity, Private and Public Committee. Linda, would you mind calling the meeting to order, please?
Sure. Thank you, Chair Frey. This meeting is being conducted as a virtual and in-person meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Fave?
Present.
Mr. Gatto? Miss Me?
Here.
Miss Langton? Here. Miss Martinez? Miss Ginsburg? Miss Martin? Mr. Kehoe? Mr. Jones? Okay, trustees, please use your raise your hand option to be placed in the queue. At this time, we may start with the agenda.
Awesome. We need a motion to make a second, and Linda will take roll. Sorry.
For the minutes?
I approve to approve the minutes from last time, and I need a motion to have a second.
I move.
Okay. Mr. Fay?
Aye.
Mr. Gatto? Not here yet. Miss Me?
Aye.
Miss Langton? Aye. Okay, the motion passes unanimously.
Any public comment?
None.
Seeing none. All right. Well, growth team, we would love to hear your presentation.
Thank you. Good morning, Chair and committee members. DDA and I are here to present a performance review of the growth functional category. This is the first in a series of performance reviews for functional categories in their asset classes, which will be covered at upcoming Board of Investment Committee meetings. So we will begin with the role of growth in the total fund, and then we will execute performance reviews of the global equity portfolio and private equity portfolio. So I'm going to move on slides here. Is it working? Here we go. So as noted in LACERA's investment policy statement, the role of the growth functional category is to be the primary driver of long-term total fund returns. In 2024, the board approved strategic asset allocation set the target allocation to growth at 48% of the total fund. The current allocation weights of all functional categories can be seen in the pie chart on the top left of the slide. With the inception of the functional category structure in early 2019, LACERA implemented a total portfolio framework that incorporates cross-asset class investment team assessment to evaluate the return and risk profile and portfolio fit of each investment. The growth functional category consists of three asset classes. You can see them here at the bottom of the slide: global equity, private equity, and non-core real estate. These asset classes and their investment policy targets, ranges, and benchmarks are also noted in this table. And for this presentation, we're going to focus on global equity and private equity. Non-core real estate will be discussed at a future meeting with the Real Assets and Real Estate Committee for their performance review. Note that the functional categories and asset classes are within board-approved policy guidelines. Performance for the growth functional category and its underlying asset classes are summarized in this table on the slide. While the growth functional asset category has slightly underperformed its benchmark over the longer term periods, the 5 and since inception, growth has delivered strong absolute returns, such as, for example, 11.5% over the past 5 years, outpacing all other functional categories and exceeding, more importantly, capital market expectations from the 2021 Strategic Asset Allocation Study. Broadly speaking, over the past several years, concentration among the Magnificent Seven stocks has attracted ever more capital and driven their stock prices to stratospheric valuations, presenting a headwind for all investors, especially diversified investors like LACERA. Focusing in on the chart here on the left, we show the sector exposure with the bars on the left side of the chart representing the growth portfolio. That's global equity and private equity combined. And sorry, that's on the right side of the chart. On the left side of the chart, we have the benchmark, which is the MSCI ACWI IMI index. Now, all the exposures are within 1% to 2%, except for information technology, that's about a 4% overweight. So we fairly match the benchmark from a total growth perspective. On the left side of the slide, or on the right side of the slide, you can see those exposures for the global equity portfolio and for the private equity portfolio. Now, with respect to the global equity portfolio, those variances are very close, maybe 1 or 2%, but that's a decision that's driven by the decisions of the active managers underlying the portfolio. And as we'll get into the description later, the active management is a smaller part of the portfolio than passive. With respect to private equity, the sector exposures here actually reflect more of the opportunity set for private equity investors, and they're not necessarily similar to the public company profile of the MSCI ACWI IMI index. So I'm going to move on to the global equity performance review. But before I get into the actual performance, I'm going to start with the market commentary to set kind of the stage for how the global equity portfolio performed. So starting with the top left chart, we show the performance of the US market relative to non-US markets within the MSCI ACWI IMI index, which is the global equity policy benchmark. The US market comprises about 63% of the broad index. And as mentioned by John in multiple CIO commentaries, the US, primarily driven by the Magnificent Seven, outperformed non-US markets in 2023 and 2024. But in 2025, the rally broadened out to non-US markets, some of which was driven by earnings growth in Europe and a slight decline in the dollar. The bottom left chart shows the performance of large cap stocks and small cap stocks within the US market. Large cap stocks outperformed all 3 years, again, mostly driven by the Magnificent Seven and AI-related stocks. The chart on the bottom right highlights the regional performance over the 1 and 3 year periods. The non-US markets, which include the emerging markets and developed markets, had very strong returns in 2025 of over 30%. And the bullets on the right provide more insights into market performance.
Dale, can I ask a question here? And I don't know if you guys had the opportunity to do this, but given the role that the Magnificent Seven played in some distortions, from what I hear you say here, is there a short commentary you can give? Did you guys take a look that if you took those 7 stocks out, how did we perform kind of within that without the distortion? So is the distortion itself the Magnificent Seven and our exposures to that? Or if you take those out, would we find that maybe we did a little better, or what's?
Within the public equity portfolio, since we're broadly diversified, and I'll get more into my comments in this, but we have exposure to those stocks. And to the extent that we would have extracted them, then we would have made a big bet against the benchmark and not being in those stocks.
Okay.
So it's kind of a trade-off there. And so we do get the benefit of the price appreciation in those stocks. We may be fractionally underweight, but we're also making up for it in stocks where we may be have a higher exposure to better. Some examples were like last year, Samsung was up 300%. And so we were overweight there. So there's just kind of trade-offs in how you assess the portfolio. But we didn't extract the Magnificent Seven to see how much it would have impacted the portfolio. So here we show the role of global equity within the growth bucket. Global equity is currently 65% of the growth category and has a target allocation of 29% of the total fund. The primary role of global equity is to deliver beta, or market returns, with a secondary focus on alpha, or excess return, with reasonable levels of risk. Within global equity, the passive index, or passive component, or index equity makes up 60% of the portfolio, and non-passive strategies are the remaining 40%, including up to 10% for the emerging manager program. Global equity has consistently been above its target allocation due to the strong performance of markets, as I noted in the earlier slide. And as a result, we have raised over $8.3 billion in capital to fund benefit payments and to provide capital for other asset classes to achieve their asset allocation targets. It should be noted that the portfolio and sub-strategies are within board-approved policy guidelines. In this slide, we are showing performance on the left side under the darker blue headers, with risk metrics on the right side under the lighter blue headers for the global equity portfolio and its subcomponents. First, I'm going to give a couple notes. So while the global equity portfolio was formed in April 2019 as part of the functional category formation, Other strategies have since been funded, which is leading to different inception dates as noted in the column all the way to the right. For example, the single index was implemented in January 2020. The factor-based strategies were implemented in July 2020, and the emerging manager program was incepted in June 2024. So I'm pointing this out because the various inception dates can influence the comparative analysis of the risk metrics on the right side of this table. For example, the risk metrics for the emerging manager program incorporate a relatively short time period of 18 months versus the factor-based and active management strategies, which have over 5 years of return observations. Second, and as I mentioned before, the policy benchmark for the global equity composite is the MSCI ACWI IMI index, a broad index that covers 47 countries and has over 8,200 stocks. These sub-strategies within the non-passive composite have blended benchmarks because they are weighted by the allocations to the managers. So that's why it says custom benchmark there. But ultimately, the benchmark for the non-passive composite is the MSCI ACWI IMI index. So when we put them all together, they should look like the index. So now we're going to get to performance. So as of December 31st, 2025, the global equity portfolio has captured market beta and delivered modest excess returns over all time periods, with reasonable levels of risk as shown in the dashed blue box at the top. Absolute returns have been especially strong over the 3 years at over 20% per year, but even the 5% is over 11% per year. Again, capital market expectations in 2021 were for global equity to deliver just under an 8% return. Relative or excess returns above the policy index have also been positive over all time periods. As we look through to the sub-strategies, the passive composite captures the market beta with some excess returns due to structural advantages, such as reclaiming foreign taxes withheld on dividends because we're a tax-exempt investor. The non-passive composite also provides market beta, but sources alpha through different approaches. For example, the factor-based strategies have very low tracking error, less than 1%, and we have expected excess return on those strategies of about 50 basis points. These strategies make small systematic deviations in stock weight relative to the index to capture mispricing based on various factors. And over the past 5 years, they have returned over 13% with 96 basis points of excess return per year. The active X emerging managers composite includes managers that invest in less efficient areas of the market, such as small cap, non-US, and emerging markets. We would expect that these would be about 2% in tracking error in aggregate when all the managers are put together, with about 2% in active returns, hence an information ratio of 1. The active X emerging managers have a return of nearly 10% with 220 basis points of outperformance over the 5-year period. And as a reminder, the emerging manager program was funded just 18 months ago. The strategies employed by the managers within this program focus on narrow areas of the market, and they're generally concentrated in a smaller group of stocks and thus can have higher performance volatility, both absolute and relative. This slide displays performance reported on the previous slide, but in a graphical format over the past 3-year time period for the global equity portfolio and 2 composites in the top left chart, and for the sub-strategies in the bottom left chart. The bullets on the right side provide more nuance into strategy performance. But as I mentioned in the market commentary, and as we discussed earlier, the Magnificent Seven were significant drivers of the broad index over the past 3 years. But the global equity portfolio is broadly diversified across capitalization segments and regions. So any deviations are not meaningful, regardless of concentration within the index. And the portfolio will have exposure to those stocks close to their index weight. Finally, we parse the performance of the global equity portfolio to assess whether it meets our expectations. The allocation effect measures the impact of our portfolio construction decisions, such as how much do we allocate to passive, to active, to the factors, and we would expect this performance impact to be minimal. And as summarized in the bars all the way to the right, The allocation effect is minus 0.01%, essentially neutral. The selection effect measures the impact of manager selection and their strategy execution. And we would expect this value to be the primary driver of outperformance and contributor to excess returns. And as you can see, for the 3-year period, the selection effect contributes 50 basis points of the 54 basis points outperformance annualized. Finally, the equity overlay program is available to mitigate misweights between regions, US and non-US, and capitalization, large cap and small cap in the US. We expect this to deliver minimal performance impact as exhibited by the 5 basis points of excess return. Currently, we are not using the regional overlay as the misweight between regions is small, and we can manage that through adjusting manager allocations. To sum it up, we are pleased with the global equity performance, both absolute and relative, and the portfolio is aligned with objectives to provide market returns and excess returns at reasonable levels of risk. We'll now hand it over to Didier to discuss the private equity portfolio.
Good morning, Chair and trustees. We'll begin our private equity review with some market commentary. On this chart, we have total private equity deal activity on a global basis. It's measured in 2 dimensions. It's measured by total deal value, which is the aggregate value of transactions in any given year, and the total deal count, which is the total number of deals closed in any given year. It's interesting to note that deal value and deal count both peaked in 2021. And 2021 is an important year for several reasons, and we'll talk about it through the presentation. But 2 right now are, 1, that's when peak valuations occurred in private equity. So we had the most amount of transactions, the highest transaction value occurring at peak valuations. It also marked the end of the low interest rate environment, as in 2022, the Fed started to aggressively increase interest rates to combat inflation. Higher interest rates makes buying companies at higher valuations much more difficult as leverage is more expensive. As a result, what we've seen is deal count steadily decline year over year as private equity managers have focused on their own portfolios and value creation rather than transacting in new companies. And ultimately, lower realizations lead to lower private equity returns, as typically there is a jump in valuation when companies transact between private equity managers. That is a stark contrast to the commentaries that Dale made earlier about the public markets. LACERA's policy benchmark for private equity is the MSCI ACWI IMI plus 200 basis points. The simple illustration is if the benchmark generated 10%, or the index rather generated 10%, our benchmark is 12. And as Dale mentioned, the Magnificent Seven are a big portion of the growth of the MSCI ACWI IMI. No doubt that the stock appreciation of NVIDIA is impressive at nearly 1,400% over a 3-year period. What is more remarkable is that the sum of these 7 stocks' market capitalization is $21 trillion. And that exceeds many of the estimates for the private equity market globally at $19 trillion. I think they should rename these 7 stocks to the Significant Seven because of their contribution to the MSCI ACWI IMI index. On a 1-year basis, they contributed 31% of the index returns. And they've had an impact over a long term as well, generating 24% of the index's returns. So when we compare private equity returns on a long-term basis, on the right-hand chart, we can see that the Burgess Private Equity Pooled Index has outperformed on a rolling 10-year basis to the MSCI ACWI IMI. But that outperformance has significantly narrowed as these stocks have driven up the index. With this context in mind, we turn to the LACERA portfolio and the overall structure. There are 4 pie charts on this slide. The left 3 pie charts are different ways to look at LACERA's $14 billion of private equity net asset value and adherence to our guidelines. In all cases, LACERA is compliant with the board-approved investment guidelines. But starting with the left chart, primaries or fund investments comprise 71% of the total portfolio, followed by co-investments, which are concentrated and intentional investments into companies or groups of companies alongside private equity managers. And finally, we have fund of funds and separately managed accounts where a third-party manager invests on behalf of LACERA. From a geographical perspective, 76% of the portfolio is allocated towards the US, with the remainder in non-US. And from a sub-asset class perspective, 76% of the portfolio is buyout oriented. Buyout is a much larger asset category. There are many more funds and allow us to deploy significant and meaningful amounts of capital to managers. But nonetheless, we have a significant amount allocated to venture capital and growth equity, as that is a higher return but higher risk strategy. The last chart on this page demonstrates vintage year exposure, and exposure is market value plus uncalled commitments. And I'll draw your attention to 2021, again, a significant year, not only because of my market commentary, but because that was a year where the board elected our new strategic asset allocation. In that year, private equity's target increased from 10% of the total fund to 17% of the total fund. And subsequent commitments to 2021 have been larger as a result of us trying to get to our target allocation of 17%. So that turns us to performance. On a 1, 3, and 5-year basis, LACERA's private equity portfolio has underperformed its policy benchmark. The predominant driver of this underperformance is the public market dynamics that we've discussed throughout these presentations, followed by our allocation to 2021 vintage, and followed by venture capital and technology investments, which had historically helped us drive higher returns, but subsequently have pulled back. If we take a look at the portfolio through a peer universe, meaning let's not compare it to a public market universe, let's compare us to the private markets investable universe via the Burgess Global All Private Equity Index, we can see that historically 92% of our vintages rank in the second or first quartile. And that number increases to 100% when we look at it over a 5, 3, and 1-year vintage. This performance underscores that we are performing well relative to the investable universe in private equity, and that our underperformance is primarily driven by public market dynamics. Turning to our co-investments and secondaries program, this is the most intentional part of our portfolio, where we take concentrated positions in companies alongside our private equity managers. The co-investments and secondaries program has outperformed LACERA's core private equity program, generating a 16% net IRR and a 1.5x net multiple of invested capital. Notably, co-investments rank exclusively in the first and second quartile across all vintages, while secondaries rank mostly in the first and second quartile. The portfolio is well diversified across the 6 sectors listed on the chart below. What's not on the page is that our 6-person team has committed $2.3 billion to 47 transactions, which has saved us over $100 million in fees that we would pay external managers to deploy the same exact strategy. And with that, we turn to our external managers. We have JP Morgan, Hamilton Lane, Pathway, and Morgan Stanley. JP Morgan and Hamilton Lane comprise our emerging manager program, with Hamilton Lane deploying our latest tranche of capital. Pathway and Morgan Stanley are legacy investments. Our last commitment to those managers was over 11 years ago. Similar to our core private equity program, these managers underperformed the MSCI ACWI on a 1, 3, and 5-year basis. While Hamilton Lane is showing good results on a 1-year basis, it's worth mentioning that there's only $53 million of NAV relative to the $400 million that we committed to that program. So there's still room for additional performance to change. And with that, I'll stand here for questions.
Jamie.
First of all, thank you for the performance review. I believe this is the first time I've seen one, my 3 years on the board. So appreciate seeing that, because the growth is always shown on the CIO report as one functional category without the breakdown. So this tells the story is much better. So my question is, I looking at the chart on, page 16 that accounted about 60% of investment is about in the age of 1 to 5 years and 3 to 5 years. So our 3-year, 5-year performance on slide 17 is 5%, 13%, right? So underperformance, right, under the benchmark. So let's put aside the benchmark. Let's look at the performance alone, right? So private equity on the risk return profile is relatively higher risk and we expect higher return, right? Is that a return that we okay with? We're okay with that kind of return with the risk that we take in, especially in comparison to credit, right? Credit is lower risk, but we are achieving this kind of return. So does it mean that in private equity, we are taking uncompensated risk with this portion of investment?
Thank you for your question, Trustee Mee. I think to help contextualize returns within private equity, we can turn to this slide, which takes a look at performance relative to the entire private equity universe. So while you do point out lower absolute returns on a 1, 3, and 5-year basis, if you look at this chart, the 1, 3, and 5-year performance of LACERA relative to the entire private equity universe is above median, if not in the first quartile. So while the industry overall is having lower returns, we are outperforming the industry. Your question regarding compensated risk is these vintages usually take time to evolve. And one of the comments that I didn't make in the presentation, but it's worth revisiting, is that at the time of the 2021 strategic asset allocation, Makita's capital market expectations for private equity were 8%. And that 8% determined our allocation moving from 10% of the total fund to 17% of the total fund. And over a 5-year basis and a since inception basis, we're outperforming that 8%.
Thank you. Will we be able to expect, this portion of investment, right? The one that like 1 to 5 years, 60% of them, will we be able to expect them to perform better as it go on, since this is long-term investment?
Many of the later vintages typically exhibit what's called the J curve, where initial investments are seen as negative, sometimes deeply negative, as managers start to call management fees down to search for companies. But then as they are investing in companies, those companies start to grow in value and change. So there's typically lower returns in the first 3 years, and we would expect the performance of the portfolio to improve over time.
Okay. I'll wait to see that on this floor. And one more question. I noticed like our co-investment is doing really well, right? There's a program. Since we do well in that area, do you think it would be good to allocate more, do more of co-investment rather than primary?
That's a conversation to be had during our strategic asset allocation and subsequent structure reviews. At the moment, the program is designed such that we can do up to 30% of an annual budget in co-investments and secondaries. And the team is very much focused on sourcing these opportunities, finding managers that deliver a lot of co-investment opportunities and bringing them to committee.
Got it. Thank you. This is all my question.
Yeah. So question for you then, in the performance drag that we see currently, let's say over the last 5 years, I understand kind of relative to the 8% assumption, we're doing better, but relative to the other benchmark that we're behind. Given that the dynamic in the industry right now is whatever 7 or 10-year assumptions you had about exits, and that it's now extending out, how is that impacting the expectation of the performance if all of a sudden a 7 or 10-year assumption about when we would be getting capital back and returns now becomes 12, 13 years? So that's one part of the question. And then kind of related to that, understanding for some of the industry things that I've attended, that now there's all these new continuation vehicles that are being set up as a way of, thank you. I was trying not to use a pejorative, but just say extend and pretend. Does that alter? I don't know if we envisioned that at the point when we made the 10 to 17 leap, and how are we accounting for that, if at all, or is that something we just account for newly in our 2026 structure review? If you wouldn't mind, thank you.
Trustee Jones, I missed Chair Fay's comment. Extend and protect, understood. So first, extending the life of any of a private equity vehicle is going to decrease IRRs. So on a like-for-like basis, those capital market expectations that were 8% should be lower, as the time value of money accounts for extending the life. The private equity managers that we speak to and discuss their performance tell us that multiples of invested capital will remain somewhat in line, but to expect IRRs to be lower as they continue to generate value. It goes with kind of the market commentary that I started the presentation with. Bluntly said, we didn't expect the rise of continuation vehicles to be as large as they are today, or as prolific as they are today during the 2021 strategic asset allocation, even though we were participating in continuation vehicles through our secondaries. The impact of these vehicles is still yet to be determined, because typically private equity managers have the most amount of information about their companies and industries and decide to transact at a certain threshold of returns. Continuation vehicles help extend the life for a certain private equity manager who can then exit potentially in 2 years, 5 years, an undetermined period of time. And so the results are still to be seen, but because we evaluate secondaries, we have some understanding of what goes into underwriting them.
One more follow-up question, if you don't mind. So then as we go into new private equity investments, are we adjusting our expectations on the 5 to 7 or 10-year window accordingly? Is there now a broader industry acceptance that 10 years may not necessarily be the closing into the fund?
The short answer is yes. The long answer is that these are nuanced discussions that occur during diligence, and that the bar to get into our portfolio has only increased, because we still are focused on growth and generating growth-like returns for the fund. And sometimes funds that have lower thresholds may not make the cutoff.
Yeah, because obviously there's some impact on our liquidity assumptions that you mentioned, the $8 billion or so that we generate overall from the growth part of the portfolio to pay benefits. I imagine if things are being extended and things of that nature, it has to have some impact on those assumptions as well. Okay, all right, thank you, Didier.
Thank you. Good morning, and thank you for that extremely understandable explanation. It was very straightforward, and I really appreciate that I understood it. So on page 16, under portfolio structure, the last pie chart, vintage year, you indicated that in 2021, we had that strong year and we went to 17% because of our strategic allocation. And then I thought you said that the years after were higher, but I see lower in the pie chart. So I just didn't understand what that was.
Thank you for your question. The clarification is that 2023 and 2024 are larger allocations than 2019 and 2018. And if you look at 2024, it's about the same size as everything pre-2016. So as our allocation to private equity increased in 2021, the subsequent years from 2021, 2022, and 2024 increased in terms of the total amount that we committed to private equity managers.
So it's 17 plus the amounts that you're listing in 2022, 23, 24?
I understand your question. So what the pie chart demonstrates is the amount of capital that LACERA has committed in any given year. That's independent of the 17% target allocation to the total fund, but it's part of the equation. So if we were to throw round numbers to 2021, that would be approximately $2.5 billion were committed that year. Those $2.5 billion are committed so that the LACERA total fund allocation or private equity allocation to the total fund increases from 10% to 17%. And most recently in 2024, that allocation number or the number that we put out was also roughly over $2 billion to help us maintain our allocation near 17%.
So I think what that also means is that we deployed at the top of the market. And those 2 years, 2021, 2022, are going to be the ones that caused low returns for a while because they were at the highest valuations. For us to get past those valuations either means that the companies would do really, really well or that interest rates come down. And those are things that are outside of our control. I have a question. So I look at the SMAs and I see the performance or underperformance, and then comparing that to the great work that our team internally has done, knowing that we have to talk about that for our strategic asset allocation for this year. Do you think it'd be easy to take more if we were to allocate more? And this, given the size of the team, it's hard to find this stuff and it's a lot of work to do. So how much more work would it be to increase the size of the team so we can keep on getting these returns with higher numbers allocated?
You know, I could talk about team dynamics, but I think perhaps John may be better suited to talk about our team and overall size.
Okay.
Yes, is the answer. Good morning, trustees. I think that subsequent to the strategic asset allocation, we perform structure reviews across all asset categories, set guidelines for things such as primaries. And I know, as Ms. Mee mentioned, do we do more non-primary type investments? So absolutely. It's something that, you know, as Didier likes to say, it's in the lab. I think that, and it's something that I will talk about when we reconvene in my CIO commentary. I think that there are some areas where we want to structurally, systematically increase performance in private equity by thinking about it differently.
One other comment just for all my colleagues on the board, and this is something that I thought of, so take what you will. We wanted to get more private equity because we wanted to, in 2021, because it made more sense because the market was doing really well. Right now, it looks like we're doing less, but as we go for future allocations, try not to follow what has been, but look at what will be coming in the future will be really important. So no baby with the bathwater stuff.
If I could, please, just on the strategic asset allocation, we're focusing on one very narrow aspect of it. So as part of that, there was a big increase in private equity, but there was also a very large increase or decrease to the fixed income portfolio. And so all of the losses that accrued to people who had much larger fixed income positions were taking mark-to-market losses throughout all of 22. And that's when you look at total fund performance for that period of time with rising interest rates, you guys were like the top 5% of all public funds. So lots of different things go into baking that cake and focusing just on one where maybe that was mistimed, and we'll see what happens as those vintage years do mature. There were other decisions that were offsetting some of what you're seeing in this presentation.
Thank you for making us feel better. All right, any other questions? All right, I think we're done. Motion.